Ted, good to speak with you again. Um, we've got an interesting company to look at today, GallifordTry Holdings. And this came as a request from one of our viewers. And by the way, if you're a viewer watching any of our videos and you're interested in the company, you would like a bit of our analysis on that, whether you're investing in them, thinking about doing business with them, or even if you have an interview coming up with them, leave a note in the comment section and we will do this for you. So Tom Lowe, thank you for your comment. And here is this video for you. Now, Ted, GallifordTry Holdings are a construction company, and they have taken quite a bit of a hit during the COVID pandemic and the subsequent lockdowns. And it's going to be really important when we look at their analysis that people understand the context for which they're playing in. And a big survey was done in the UK with about 900 executives from this industry. And 70% of those executives found that their revenue has decreased, some of which by 20%, some of which by over 50%. And their projects were actually delayed by up to 32 weeks. So that's a big deal for the construction industry because their profitability is all about how fast and how quick they can actually get these projects completed. So any kind of delays is going to have a really big impact. And to make things even worse, they've been affected by the supply chain situation around the world as well. So they can't even get the materials in that they need at an efficient process. So Ted, what did you find out about GallifordTry? How have they fared throughout the past year and through the whole COVID lockdown?
Well, Moe, good to hear from you. And absolutely. So let's have a look at the financials of GallifordTry. I've never heard of them, I have to admit, before we got the request through. Are the financially, it's rather a kind of light grey. So I'm hoping that you can see these. And what we see first of all is on this side, this is all about 2020 and this is all about 2019. We'll notice when we're actually dealing with to the year June 2020, so halfway through 2020. I'm always interested when a company produces this. What they do is that they've got three columns. They've got pre-exceptional items, and then they've got some exceptional items, and then they've got the total here. Now, when I see this, I look at exceptional items, and this is kind of things which didn't happen last year and won't happen again next year. They're kind of one-offs, and the way that people present these is to kind of say, don't worry about them, it's never going to happen again. Well, you know, in my experience, exceptional items seem to have a habit of happening every single year. So if we're going to be looking at these numbers, let's just concentrate on the total columns here for the sake of this analysis, which we're doing, which is a fairly brief, high-level analysis. To reiterate what you mentioned before, Moeed, sales, you will see, has dropped by about 20%. So that's the first thing that we noticed from this company. The next thing we notice is it's low margin. I mean, wow, is it low margin? On 1.1 billion of sales, they're making less than 30 million of gross profit. And in the previous year, 1.4 billion of sales, they made less than 10 million of profit. So this is, I mean, that we're talking about, you know, a 3% gross margin this year, 1% gross margin last year. These margins are razor thin, and there's really no room for error in that kind of, you know, if you're operating in that kind of margin. Give you an example, Coca-Cola operate on about a 40% gross margin, no, 60% gross margin. So they've got lots and lots of space to kind of operate. Okay, so that's the first thing we notice. We scroll down to the bottom line, to the bottom of the revenue statement. Here it is, and we notice we're going to be looking at this number here. So this is the profit from operations in the year, and it's not a profit, it's a loss. So they are actually making a loss bottom line, both last year and this year. In fact, they're making a loss on an operating basis. So this is the operating profit, is an operating loss. So they are making a gross profit, but it's a very small gross profit. But because of the costs of running the business, the sales, general and administrative costs in there, then they are actually making a loss as a result. We'll notice here also, just by passing this finance, the finance costs, this line here, this is the interest they pay on the debt. It's quite small, which suggests that they don't have a lot of debt weighing down their balance sheet. But that's the first thing we look at here. Very, very loss-making business.
And just a question on the finance income, just for our viewers. Can you explain what that is?
So the finance income will be typically, an income you receive based on, you've got lots of cash in the bank and you're earning interest on that cash. So this is quite a big number. And if we want to see a little bit more about this number, which we might do, we might say, oh, why have they got so much income? The place we would go is go and have a look at note number 6. So now you've called it Moed. Let's go and have a look at note number 6 and see exactly what makes that 5.8 million pounds, which is a fairly substantial amount in terms of the size of this profit and loss account. So here we have note number 6, and you'll notice that they have interest receivable from PPP investments and joint ventures. So PPP is the the public-private partnerships, which is effectively a way of financing. So effectively, historical builds were constructed in a joint venture, effectively between the government and the private sector. It was very much the way of the government kind of moving costs off their balance sheet, and they would pay the constructors on an ongoing basis. And effectively, what we're seeing here is some of that income that they're receiving based on things that they constructed, assets they constructed in previous periods, which are now owned and run by the government. Okay, so that's effectively what's happening there, and it's really saying it's not part of their, their kind of day-to-day operating model, but it is quite a nice income stream that kind of keeps the company ticking along. So let's have a look at the balance sheet. Now, the balance sheet, we're going to be looking at the group balance sheet. So we're looking at these 3 columns here. And we notice that we've got for the 1st of July, as at the 1st of July 2018, and then the 30th of June 2019. So that's 2 years ago, 1 year ago, and the 30th of June, which is the end of the year that we're actually looking at. Again, we just noticed this line here, it just says restated, and have a look at notes 1 and 40. So we kind of want to have a look at notes 1 and 40 just to see, what are they restating? What's going on in this company? Is there something I need to be aware of? And this is where we suddenly find our first real understanding or sort of indication of something's going on in this company. Here's note number 1, and we notice here it says in the second paragraph that following the disposal of Linden Homes and Partnerships, etc., etc., etc. So it looks to me like this company has done, it's a fundamental restructuring, and they've basically sold Linden Homes and Partnerships, which is their kind of their house building division. They've just sold it out, and they've just said, we're just going to focus on one particular area. Now, that's probably going to account for a significant amount of the fall in the sales, for example, but it doesn't necessarily mean that this is now turned into a profit-making business, or at least not so we've seen in this company, in the figures so far. So let's have a look at the balance sheet. So picking up the key numbers in the balance sheet. So the non-current assets, this is the sort of the stuff we need to run our business. And we notice that they've really just shrunk the size of their balance sheet. The big number here, you can see trade and other receivables. This is obviously money that they were going to receive. It's long term, so they're not going to receive it within a year. So their business model is obviously, being paid, much further out into the future, and that has gone to 0. So that will be a reflection of the part of the business that relates to has obviously been sold. So they've shrunk their non-current assets, the things we need to run the business, from 543 million pounds down to about 158 million pounds. And similarly, the current assets, that's the cash and things that are going to become cash very soon, have also been shrunk very, very significantly. And you'll notice that all of this development, so this is kind of houses in construction, it's all off the books. They just got rid of it. So development is effectively their word for stock, I would say. Trade and other receivables has shrunk a little bit, and the cash has come down as well. So really the balance sheet, you can see here that the assets have shrunk from about 2.7 billion down to 625 million as a result of the sale of this part of the business. Looking at the bottom half of the balance sheet, so in exactly the same way that the assets have shrunk, so the liabilities have shrunk. So here we see their trade and other payables has come down significantly. So the current liabilities down from 1.8 billion to 4.8 billion, and the non-current liabilities has also shrunk fairly significantly. And we notice here that, for example, they basically just got rid of all the debt, so there is no debt sitting on this company. So they've really just eliminated any debt sitting on the balance sheet by selling off part of the business, and now it's a clean, it's debt free, and it's focused now on its construction rather than the house building part of the business. So cash flow, quite interesting. The first thing we notice on the cash flow is this line here says that in spite of the fact that they sold the business, they're still losing cash. So this, if you remember, Moeed, we've been talking about this number for a while. This, I think, is the most important number in the accounts, because it's, are you generating cash from your underlying operating activities? And the answer for these guys is no, they're not. They lost 6 million in cash the previous year, and it's 152 million in cash this year. So profitability is important, but cash generation is absolutely crucial. They haven't sorted out their cash flow generation. They are not generating cash. Cash flows from investing activities. Here we can see that it's gone positive, and the reason it's gone positive is because of this number here, which is the sale of the discontinued business. So they basically got 362 million from selling part of the business, which is good. But of course, that didn't happen last year, and guess what? It's not going to happen next year. And then they've got the financing here. So a bit of cash used in financing. So it's really driven by this number here, which is effectively their they're using it to pay off the debt of those discontinued activities. So overall, they're generating cash compared with last year when they were losing cash, but they're generating cash because they've sold part of the business. So it'd be really interesting to see, now they've got rid of the business, what does the business look like in a kind of on a pure play basis without being muddled up with house building and construction, if that makes sense. Just one thing to notice also that kind of jumps out at me is going back to the balance sheet, is looking at these numbers here. So one of the things we always look at in the balance sheet, Moeed, is the liquidity ratio. And the liquidity ratio is where we are comparing the current assets to the current liabilities. And the current assets are 468 million, and the current liabilities are 482 million. We like, in an ideal world, for current assets to be higher than current liabilities, because current assets are things that we own, which are assets we own and are either cash or going to become cash soon, and current liabilities are things I have to pay soon. And really we're saying, do we have enough cash to pay our bills on time? And if we don't, then there's a bit of a problem. Now, these guys got into trouble because they were delaying paying their suppliers. And I did a sort of rough back of the envelope calculation, and I found out that it was, when they, in terms of their house construction, it was taking them about 210 days to to clear their houses. Their accounts receivable were another 183 days. They were taking 290 days to pay their accounts payable, to pay their suppliers, their creditors. Now, you can pick this out by working it out from the numbers. So you need to be careful if you're a supplier to a business like this, being able to read that suddenly says, do I want to be doing business with this company? Because if you do business with a company and they run out of cash and they go bust, you're not going to get paid, or you may, but you're going to get paid a lot later, and it's probably going to be about 30p in the pound type of thing. And even today, the accounts payable is at 288. So it's 288, their accounts receivable 150 days, accounts payable 288 days. Well, that's good, because for the company, it means they've got, they should be having positive cash flow now, but still, do you really want to be supplying a company that won't pay you for nearly a year? Not sure I do.
That's very interesting.
It's kind of, it's eyes wide open here. So that's really, for me, was the kind of, the big sort of, highlight for these guys: negative working capital, negative cash flow. It's just, I don't think they're going to go to the, I don't think they'll go to the wall in the next 12 months, but it would be very interesting to see if they can clean their operation and really get back to, cash flow, get on top of their accounts payable, which they haven't managed to do. It's still at 460 million. It's still a big number, and that's really all they owe. I mean, that's basically the only liability is this trade and other payables. So once they're on top of that, then they need to focus on, obviously, raising those margins, because you can't operate a 1% gross margin. You're never going to make it.
That's really, really interesting. So what does this mean about, because they're a public company, so what does this mean about their share price? Because I think before the pandemic, they reached a high of £150. It took a bit of a dive, but I believe it's now at, you've got it at 129.
Yes.
So it's gone up about £2 since yesterday when I looked at it.
Yeah, so it's quite interesting looking at the so here, here we see very simply, this is the housing bubble, for example. So from 2003 to 2008, the whole kind of, all the sort of the house building and the housing prices, etc., etc. What a great investment. And then, of course, as the housing, as the dot-com, not the dot-com, sorry, the global financial crisis and the credit crunch happens, they take a massive dive. Then they sort themselves out and they start this steady meritocratic rise back up again. And then they kind of wobble a little bit, and they've been kind of wobbling all the way down to here. And then basically, they just run out of goodwill. Whomp, and you can see that, there's been a massive drop. So, the summary is that the market cap is 143 million. Okay, so that's this number here. We've got a net asset value, so that is this number here. There it is. So really looking at this number here, this 120.5 million, this is the net assets, which is the equity investment by the shareholders, and that's known as the book value, or the net asset value of the business. The book value, the net asset value. So in effect, we're saying that if you buy this company, you're going to pay 143 million for 121 million of net assets, which means the inherent goodwill is only 22 million. Okay, so we've been looking at some stocks in the past, Moeed, where where companies have been all goodwill. I mean, you look at Deliveroo, it's all goodwill. There's nothing else in there. So these guys are cheap, but then they're cheap for a reason. So, we've looked at some companies where there's lots of good news and it's reflected in the price, and there's not a lot of kind of room for bad news. For these guys, there's lots of bad news. It's reflected in the price. Maybe there's room for good news. Now, I don't know. We had our friend Tom who asked us about the company. He said, can you have a look at it? Maybe he knows something that we don't. Personally, I don't know the company. I don't know the industry that well. It's not screaming buy to me, but it certainly says that, if you feel confident that the management are on top of this business now, that they've stripped out, they've restructured, they've got a nice core business now, then it's certainly cheap at the moment.
Yeah, that seems interesting. I mean, in my opinion, I don't think I would invest in this business. I don't know the industry very well, but it seems like if you will invest, you're banking on a lot of things going right in a period where there's a lot of uncertainty. So it will be interesting.
Well, I'll counter that, Moeed. So we're talking today about just after the Deliveroo flotation. The Deliveroo flotation is very, very expensive. Okay, and the investors are kind of finding out to their because it's expensive, there's lots of good news. And so if there's lots of good news, it's priced very expensively, which means that all the good news is priced in, which means that all that can happen is that you can lose money, if that makes sense. So if you buy something which is unloved, it's horrible, it's nasty, it's all bad news. This company is all bad news, but all the bad news is in the price. So you're not going to get a lot more bad news, but you could get good news. Okay, so you're starting to think about, so quite often it's quite nice to think about a company that, you know, everybody hates it. Well, that's great. That's what contrarian investing is about. Find something that everybody hates and buy it, because when everyone goes, actually, you know what, it's not that bad, it's quite a nice little company, quite well run, then the share price comes back again. Okay, this is what's known as value investing or deep value investing. You're finding unloved stocks that you really, really like. Whereas Deliveroo is finding a stock which everybody likes, everybody thinks is going to kind of take off and go to Mars, but it's already reflected in the price. So all you need is a little bit of bad news. We don't like the corporate governance. Some of the we don't like the way they treat their kind of their gig workers, especially in the ruling on Uber. Little bit of bad news, and guess where the share price is going? Down. This share price isn't really going to go down much further. Look, it's about as low as it can get. I'm not saying it can't go lower, and I'm not saying it can't go bust, but there's a lot of bad news. I think it's reflected in the price. That's my personal opinion without knowing the actual business itself.
Yeah, so I agree with you in value investing. I think my personal opinion is, and that's why I mentioned you've got to really know the industry, because with the razor thin margins that you're talking about, the fact that they're not actually generating cash, they're losing cash, even with the divesting of the Linden Homes business. To me, unless you know the industry, then that risk seems a little high. So that was a very interesting analysis, Ted. And look, you know, like, share, subscribe this video. And again, like our friend who made the comment and asked us to look at this company, if you have a company that you're really interested in learning a bit more about and you want our analysis and our opinions on it, do leave us a message in the comment section, and we will analyze that business for you. So Ted, until the next video, thank you very much.
Excellent. Good to see you, Mary. Have fun. See you later.
Take care.